These things are not a sign that the market's broken. It's not a sign that the market is rigged or your investment portfolio is broken or you're doing something wrong. It's just the cost of admission to investing.
Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello, everyone, and welcome back to Blind Spots. Recently, Nik, you had someone ask you, what makes a terrible investor? And this question has inspired this week's episode. So I think that it's really easy to talk about what makes a great investor, but it's more difficult to kind of give yourself a reality check, look inward and ask yourself, what could I do better? And this applies to all different aspects of life, but we all have blind spots. We know that money is emotional, and talking about the characteristics of an investor that aren't so positive may resonate with you and our listeners. So we just hope that you walk away from this episode as a more informed and self-aware investor.
And I should preface my terrible investor comments with the origin of this. So a few weeks ago, I wrote about what makes a great investor. And it is very simplistic, and it's based in empirical evidence and what's actually happened in the U.S. financial markets. And what makes a great investor is patience and optimism. And this goes back, I think 80 plus years of market data, where if you were a good saver, you stayed invested, and you didn't have any extreme dispositions, meaning you didn't jump in and out of equities, patience and optimism have been rewarded. And on the flip side, being a pessimist or being an extreme market bear, I mean, you show me a pessimist or an extreme market bear, and it's really hard for that person to build wealth. Like there's virtually a list of zero that has prospered in this country as far as an investment performer goes by being a doomsdayer. So I had someone ask me, well, okay, Nik, I read your post on being patient and optimistic. That all makes sense. What makes a terrible investor? And I was thinking about this, and I thought that was a profound question, because I think, many people have tendencies that are suboptimal, right? You might be a market timer, you might be a conspiracy theory person, you might think that you're entitled to enjoy gains and shun losses. And this shows up in many different forms. But I think these are all symptoms to a bigger problem. Where people make mistakes, it's derived from one overarching theme, and that's trying to avoid losses. So trying to avoid losses manifests itself in all sorts of funny ways, but it all ties back to that. And oftentimes when you're trying to avoid losses, it leads to huge mistakes. So an extreme example would be someone that says, oh, I've had a really good run, I've made money the last year, all of these things are stacking up, there's a lot of potential landmines in financial markets. I'm going to go ahead and pull my money out and wait for a better entry point. Well, what's happened the last 12 years? And this is not uncommon in this country. I mean, 80% of the time, the market is boring and it just slowly grinds higher. 20% of the time, things get uncomfortable. And you can go back the last 96 years of the S&P 500 or whatever it is, and it follows a similar path. Roughly 1 in 5 years, things get weird. There might be a 20% correction or worse. And then the other 80%, the market ebbs and flows, but it mainly grinds higher. And I think as professional investors, it's important for us to think in probabilities, right? When people say things to me like, oh, in 3 years, the market's going to sell off. It's like, well, that's oddly specific. And that all stems from a mindset of trying to be a savant and to time that and to get out of the market before something happens. A professional thinks in probabilities. And back to what I just said, So when I'm managing money, I'm saying, well, 80% of the time, nothing's going to happen, or the expected outcome is going to happen. That might show up in different ways. The market could spike higher, or it could steadily climb over a period of 3 years. And then I know the other 20% of the time, we're going to get a COVID sell-off, or we're going to get a housing crisis and a financial meltdown, or we're going to get the fourth quarter of 2018. Like these things are not a sign that the market's broken. It's not a sign that the market is rigged, or your investment portfolio is broken, or you're doing something wrong. It's just the cost of admission to investing.
Yeah. There's an old saying that time in the market is better than trying to time the market. And you've done some work in recent blog posts talking about historical returns for the S&P 500. And I think that we were kind of all surprised by those metrics, both short-term and long-term.
So think about what you're fighting. So let's say, and there's various levels to this, but let's say that I'm pessimistic about the market. There's always a laundry list of things that could go wrong. That's always the case in investing. There's never a period where the market says, okay, there's nothing to worry about here. It's full on gains ahead. I know people tend to focus on what's going on and they think the political scene is different, or monetary policy scene is different, or global macroeconomic landscape is different. We're all dealing with a variation of the same sort of problems, no matter what decade you're talking about. But we went back and looked at various time periods, and we're all conditioned to be long-term investors. It's not a surprise if you put money into the S&P 40 years ago, you're going to see a positive return, roughly 100%, or actually 100% of the time. Okay. What is surprising is, and I think you pulled some of these numbers, but over a rolling 16-year period, so any rolling 16-year period was positive 100% of the time, okay? Any 2-year period was positive like 85% of the time. So what that means is you can go back throughout history, pull any 2-year period for the S&P, and it's going to be positive, meaning a positive return for an equity investor 85% of the time. And I know a lot of people get worked up about entry points and dollar cost averaging and buying the dip. The cleanest answer for putting cash to work, especially if you're under 40 years old, is just plug it in, get it fully invested, and move on with your life. And you can even make the case for a retiree or someone that's about to retire. The easiest answer is just to plug it in. If you're going to be invested for more than 5 years, chances are, the odds are in your favor that you will see a positive outcome.
When you talk about investing with probabilities, 85% is pretty good odds.
Yeah, if you went into a casino and had a 51% edge on the house, you would bankrupt that casino over time. So that's a pretty narrow advantage, 51%. I'm talking about an 85% advantage. So know that it's fine to be a pessimist. Like, you can think that we're on the wrong path, or markets are expensive, or whatever you believe. But know that empirical evidence is blowing a huge, what's the opposite of tailwind? Headwind in your face. You're climbing an uphill mountain.
Yeah. So in our last episode, we talked about the biggest risks to retirees and how you can manage sequence of return risk. So for the investors with the doom and gloom kind of attitude, they're always pessimists, glass is half empty. How can they mitigate damage without placing any trades or touching their portfolios?
There are things you can do if you truly believe things are going to get ugly that have nothing to do with placing a trade, nothing to do with your investment portfolio. So one of the themes that I talked about back in 2020, which again was the weirdest year ever, a lot of people were worked up about what was going on. And there were several things that we advocated on doing that had nothing to do with placing a trade or making an investment decision or having any opinion on what happens next. And I'll rattle off a few of those. And I think it's liberating when you have this mindset that, one, negative outcomes are part of investing, right? You accept that as truth. And two, concede that we're all going to feel pain in the next recession, the next market downturn. Let's focus our attention on mitigating damage. Okay, so how can I minimize damage? So that's the spirit of my next comment, where we advocated that our clients and our readers look to refinance their mortgage. Rates went lower. Let's go ahead and save some money on interest payments and the mortgage payment. Okay, start to build an emergency fund. Right? Start to build up your cash reserve. So if, God forbid, the market did crash or it was getting uncomfortable, you had a bit of a cushion. Stress test your portfolio. I just recorded an explainer video on how you can see if your portfolio is diversified. There's a lot of portfolios out there where the investor or the advisor might think that they're diversified. They own a bunch of different asset classes, only to find out all those asset classes act the same during times of market stress. And I tell our clients all the time, it doesn't do you any good to own 30 different assets if they all act the same during times of market stress. So run stress tests. And then there's other things that you can do, like, reducing your expenses. These are boring, mundane things, but you take them all together and they really can make a difference to mitigate damage without playing the market oracle.
Yeah, and all of these things are kind of in the spirit that we talk about here often of just optimize the things that you can control. So having those items in your back pocket can give you some comfort.
Yeah, and I can tell you there's nothing more frustrating than someone who is telling me this stuff is going to hit the fan, but then I look at what they're doing in their life and it's completely inconsistent with what they're telling me. So someone's telling me the market's going to crash by 50% next year, but I'm looking at their behavior, and they're buying a second home. They're taking out a loan against their portfolio. They're lending money to their kids. They're spending more than they ever have. It's like, well, if you really believe what you're telling me, you probably shouldn't be doing these other things. So again, Erin, that goes back to your comment, is to optimizing the things that you can control. Understand that we're all going to feel pain during the next market event. Let's shift our focus to mitigating damage. Yeah, so on the crux of this podcast, and this sounds overly simple, like it felt kind of funny when we were drafting the notes for this, but you would be surprised how many people do not embrace the notion that negative market returns or negative portfolio returns just should not be a possibility for them. Like they embrace risk when times are good. Things have been really good the last 12 years, but at the first sign of trouble, they want to abandon mission. They want to abort a well thought out plan that is consistent with their financial plan. It jives with the way that they feel about risk. And it's because there's this notion, there's this entitlement out there. And again, people overweight what just happened. What just happened has been a really good market run. They feel entitled to endless gains and to shun losses. And human psychology tells us that humans hate losses like 5 times more than they enjoy gains.
Where do you think that entitlement stems from? Is it kind of a recency bias where 2021 comes off of a crazy year after 2020, and then this little 1 week blip that we've recently seen kind of throws people into a frenzy?
It's a combination of recency bias and, I mean, let's face it, this is something not a lot of people talk about, but we're blessed to be living in the United States. We're blessed to have relatively free access, unfiltered access to financial markets and information. I mean, with a few clicks, I can move money out of my checking account into my brokerage account at Schwab. And with another click, I can buy basically whatever I want. And if you look at the long-term glide path of US equities, I mean, it's about as good as it gets. I mean, we have seen the greatest passive wealth creation engine ever, and it resides right in our backyard. So I think that's kind of the context, and it's amplified by the last 12 years. I mean, we've seen relatively, from a historical standpoint, an uninterrupted juggernaut of gains. Like, I don't have it in front of me, but I think the S&P's done something like 15% a year in the last 10 years. I mean, that's a pretty big tailwind. But, on the flip side, looking at the decade before, from 2000 to 2009, if you plowed money into the S&P at the start of 2000, looked at your balance at the end of 2009, you actually lost money. So markets move in cycles. And I think when you just embrace the fact that markets move in cycles, there's going to be negative years, there's going to be positive years. History has shown us there's more positive years than negative years. You can save yourself a lot of headache. You can save yourself from making a catastrophic mistake. Because think about the opposite. Think about if we could set our watch to getting 10% a year in the equity market. Literally everyone would do it. Money market funds, bonds, banks, like the banking system probably would not exist.
Right.
But the reason that we can get 10% a year or 12% a year on average is because negative outcomes are a possibility, and they happen, and they're going to happen again. The only reason why we can get that 12% is because we have a real risk of loss. So all of these weird, I mean, Erin, you work with clients. I work with clients. I feel a lot of what we do has to do on the human psychology side of things and behavioral finance, which I think is still a relatively new discipline. I mean, you look at behavioral finance, it only was invented or talked about since the late 70s. And I just think there's a lot of underappreciated research and empirical evidence that points to how influential human psychology and animal spirits and human behavior go into financial market prices.
Yeah, I think that most people just need guidance, and it's easy to get off the rails kind of depending on what you fill your mind or your time with. And that's kind of where we step in our day-to-day activities. But
yeah, so to kind of put a bow on this, because this is a very simplistic topic, but again, you would be surprised at how many people don't accept this truth that negative outcomes are part of investing. So trying to put a summary on this, trying to avoid losses is going to lead to a larger mistake, right? Being out of the market when it continues to ascend higher. And then the flip side, this is a derail, but I've seen this time and again, you get the person that's wanting to sit in cash because they know a correction's coming. That correction actually comes, and then they are gun shy because what they were predicting actually happened, and they think it's going to get worse.
Yeah.
But that's a different subject. So trying to avoid losses leads to big mistakes. We've seen that time and again. Accept the fact that losses are part of investing. Think of it as the cost of admission or a tax that you must pay every year. Okay. Some years you might have to pay that cost of admission. Some years you might not have to. Don't look at it like something is broken. Don't look at it like the market is rigged. Don't look at it like the deck is stacked against you or you saw it coming. No, you didn't. Things are obvious in hindsight, not so obvious in the present. Let the magic of time and compounding work for you. I think Charlie Munger said, never interrupt compounding unnecessarily.
That's good.
And then if you're the type of person that says, oh, I think the market's gonna lose 50% of its value in 3 or 4 years, like, know that that's a ridiculous statement. Okay. Know that you have some serious biases going on. And if you really feel that, if you really feel like the stuff is going to hit the fan, make sure your portfolio reflects your acceptable range of outcomes. And then look at your personal balance sheet, what you've got going on. Focus on mitigating damage rather than playing the market oracle. Okay, so optimize the things that you can control outside of your investment portfolio. Look at your expenses, look at your emergency fund, look at the rate on your mortgage, look at if you have any loans that you could pay off. These are all things that you can control. You can't control external factors like what the Fed does or what the White House does, so on and so forth.
Yeah, that's all great advice. So give us your example of, what did you say? You had a personal story?
Oh, so I'm a 100% equity investor. I get the question sometimes, Nick, the market's been acting kind of schizophrenic. What are you doing in your own personal portfolio? And I look at them and I'm like, dude, I placed maybe one trade in the last 18 months in my personal account. And that's usually me just plugging in my contribution, right? I contribute to my 401k or my IRA, and then I just invest it. I don't make tactical trades. I'm 100% equities. If there's a negative year, I don't even really look at it. I don't care. I know that's a potential outcome. And I just press on. If I have cash, I might even throw it in there and invest at a lower price. But this notion that someone should freak out or get upset or get worked up over a negative market outcome, it's just preposterous to me, unless you're about to retire and then you're in that danger zone. And that's what we talked about in our last podcast, that sequence of return risk, where, if you were to take a large loss as you close in on retirement or after you just retired, that could derail your plan. But again, that goes back to making sure your portfolio fits the way that you feel about risk. Risk is consistent with your financial plan, and just let the magic of compounding work.
Yeah, something that you said about not checking your portfolio on a regular basis, I think is something that more people should abide by. We have more access to information than ever before, and you can check every account that you hold anywhere in the world within a few clicks of your button. It lives in your pocket almost 24/7, and we're all kind of glued to our phone and information that comes out of it. But I think people who check their 401k every single week or every time a contribution goes in or monthly or whatever is kind of a problem that has arisen over the last couple of years, because if you're just constantly embedded in information, you stop thinking about your long-term plan, and you're so focused on the short term that these small blips seem a little bit larger of a problem than what it really is.
Yeah, I completely agree with that. And I touched on that in our last blog or podcast, I forget. But, you get these folks that say, oh, the market's been volatile. Yeah, the market's been crazy. And then you look at actually what's happened in 2021 is setting up to be one of the most serene markets that we've seen in the last couple decades. So that's what happens when you're checking every day. It seems like it's moving a lot, but in in the historical context, it's actually quite calm.
Yeah. Something that I think is just kind of funny when you're looking at your portfolio on days like that is if you're looking at like a day or a week view, just like pinch out just a little bit and look at like 6 months or a year, and you'll be pretty amazed to see, you know, that small blip that kind of gave you cause for concern is just a small hole in the range of time.
Yeah. I mean, you're exactly right. And just from a social standpoint, like it just seems, even with my social circle, people are talking about markets more than ever. And, you know, looking at usage, like we track financial app usage, like Robinhood and financial tools online. I mean, they're dramatically up year over year. And a lot of it is because people are locked inside still with this COVID thing still going on, and they're checking their balances more than ever. They're reading more financial news. There's YouTube, there's Twitter. I mean, you can't escape it, and it affects us all. It's like this is a uniform thing. The economy and financial markets, in one way or another, affect us all. So it's just like it could be a negative feedback loop or a positive feedback loop. And that's why it's really important for you to develop these information filters, to detach emotion and money, and know that, you know, your neighbor's plan, your cousin's plan, the talking head on TV's plan is going to be different from the you plan.
That's something that we should do like a deep dive in, just how people are inundated with information and how that affects their way they manage money. Decision made. That's what we're talking about next week. So thanks for listening to this week's episode of Blind Spots. The topics that we write about and talk about all come from investors like you. So send us your questions to insight@pureportfolios.com. We also offer free portfolio reviews. So if you would like a professional investor's view on your portfolio, we'll give you insight to your fees, tax efficiency, risk metrics, and potential conflicts of interest. So you can visit pureportfolios.com/free portfolio analysis to learn more. Thanks for listening.